Hello everyone, we are Group 5. Our presentation topic today is mutual fund. I'm Christina and I will introduce you about the definition and the types of a mutual fund. My excellent group mates will share with you how the mutual funds operate and how to invest using mutual fund. Also, we will talk about the advantages and disadvantages as well as the regulation later. Now, let's begin with the definition. So, what are mutual funds? A mutual fund is a type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. Mutual funds are operated by professional money managers who allocate the fund's assets and attempt to produce capital gains or income for the fund's investors. A mutual fund's portfolio is structured and maintained to match the investment objectives. There are many types of mutual funds. According to the funds scheme, there are open-ended funds and closed-end funds. In an open-ended mutual fund, shares are issued and redeemed daily by the fund sponsor, who is the issuer of the fund. By design, these funds are always traded at their actual cash value, also known as the net asset value (NAV), which is calculated on a per share basis before sales changes are applied. Moreover, while this is the most popular type of fund, it is not necessarily the best for those who seeking income. Closed-end mutual funds, which generally provide more income to investors, issued all of their shares on their first day they go public, instead of issuing and redeeming new shares every day at their NAV. After that, the fund's market value can move just like an individual stock, free to rise and fall above and below the actual cash value of the shares. The fund sponsor does not issue or redeem any new shares on a daily basis. Instead, shares trade between other investors independent of the NAV. Of course, there are some other classifications methods. For example, if we classify the mutual funds according to the invested assets, there are equity, which is invested in stocks, fixed income, which invested in bonds, money market funds, which invested in short-term debt, or both stocks and bonds, so we call it a balanced or hybrid funds. Equity mutual funds based by stocks of a collection of public companies. Most mutual funds on the market are about 50 and 5% are some types of equity funds. Equity funds have a higher potential for growth but more potential volatility in value as well. And bond funds, it is the most common type of fixed income mutual funds, where investors are paid a fixed amount back on their initial investment. Bond funds are the second most popular mutual fund type. And the money market mutual fund and the fixed income mutual funds also, it is invested in high quality short-term debt from government, banks, or corporations. For example, the funds include U.S. Treasury, certifications of deposit, and commercial paper. They are considered one of the most safe investment and make up 15% of the mutual fund market. And the balanced funds are also known as the asset allocation funds. These investments are a combination of equity and fixed income funds with a fixed ratio of investment, such as 60% stocks and 40% bonds. The best known variety of these funds are target date funds, which automatically reallocate the ratio of the investment from equities to bonds the closer you get to the retirement.
Thank you very much, Christina. So now let's move forward to the third question of our presentation. How do they operate? Or in fact, how mutual funds work? As you may know, A mutual fund is both an investment and an actual company. This means that this dual nature may seem strange for you, but it's no different from how a share of Apple is a representation of Apple Corporation, for example. When an investor buys Apple stock, he's buying partial ownership of the company and its assets. Similarly, a mutual fund investor is buying partial ownership of the mutual fund company and its assets. The main difference is that Apple is in the business of making innovative devices and tablets, while a mutual fund company is in the business of making investments. We can find three typical ways to earn money from a mutual fund. The first one is the income earned from dividends on stocks and interest on bonds held in the fund's portfolio. A fund pays out nearly all of the income it receives over the year to fund owners in the form of distributions. This means that funds often give investors a choice either to receive a check for distributions or to reinvest their earnings and get more shares. The second way, if the fund sells securities that have increased in price, the fund has what is called a capital gain. And most funds also pass on these gains to investors in a distribution. And finally, the third way is that if funds holdings increase in price but are not sold by the fund manager, the fund shares increase in price. You can then sell your mutual fund shares for a profit in the market. Going into more detail on how mutual funds are composed, we may know that normally are constructed as a virtual company. Its CEO is the fund manager, sometimes called as investment advisor. This fund manager is hired by a board of directors and is legally obligated to work in the best interest and direction of mutual fund shareholders. Most fund managers are also owners of the fund. There are very few other employees in a mutual fund company. The investment advisor or fund manager may employ some analysts to help pick investments or perform market research. A fund accountant is kept on staff to calculate the fund's NAV, the daily value of the portfolio that determines if share price go up or down. Finally, mutual funds need to have a compliance officer or two, and probably an attorney, to keep up with government regulations. We have also to say that mutual funds are part of a much larger investment company. The biggest have hundreds of separate mutual funds. Some of these fund companies are names familiar to the general public, such as Fidelity Investments, the Vanguard Group, T. Rowe Price, and Oppenheimer. Later, in the final point of our presentation, we are going to talk about them.
All right, so let's take a look at how you can invest into mutual funds. What you want to do first is you want to choose one of the kinds of investment funds we just saw before, and you want to do that based on certain preferences you might have when it comes to how much risk you're willing to take, how much liquidity you need and when you need it, so your time horizon, how much return you're expecting to see, which is obviously going to depend on the first two as well. Costs, how much you're willing to incur. Different mutual funds have different amount of fees and costs depending on if they're passive or active. And then any other special needs you have. For example, if you want to do a socially responsible investment fund, that's something you would have to look into. And then when it comes to actually investing, you would want to do that at a bank or anywhere a fund has physical presence. You can contact the broker. You can download apps. Some mutual funds have apps, or you can just give their website a visit. Then say you've got the necessary documents, you'd want to consider either lump sum investments, which means you just get invested all at once. You pay the price right away and you're invested. Or you look into systematic investment plans, which sort of spread out the payments that get you involved. And what that does is it reduces your risk of investing at what is a peak price, especially if it turns down later. You should be aware of front-end fees. A lot of mutual funds, when you buy in, they make you pay certain fees, usually between 1 to 4%. If they're not present, then sometimes it's just reflected in heightened administration fees, or you incur those fees when you sell out afterwards. So that would be a back-end fee.
I'm going to talk about the advantages and disadvantages of mutual funds. First of all, these types of funds have a series of very attractive advantages, such as diversification. Diversification allows mutual funds to reduce their risks. They invest in hundreds of securities such as equities, debt, money market instruments, in order to spread risk. Secondly, we can talk about the advanced portfolio management. A mutual fund is favored because it doesn't require the investors to do their research and asset allocation. A fund manager takes care of it all and makes the decisions on what to do with your investment. Now, economies of scale. These types of funds benefit from their volume of buying and selling securities in order to reduce their transaction costs. Accord with your financial goals. When we talk about your financial goals, we talk about to find a mutual fund that matches your income, expenditures, investment goals, or risk appetite. And finally, we have liquidity. I mean, it is relatively easy to exit a mutual fund, but just you have to be aware of possible exit load or pre-exit penalty. Now, we're going to talk about the disadvantages of mutual funds. Firstly, we have the costs of professionals management. And this is because higher management fees don't guarantee better fund performance, and the salary of the fund managers comes from the investors. Secondly, look in close. There are two different mutual funds structures. One allows you to go in and out at any time, and the other one is locked in for 4, 5, 7 years. With this one, if you try to take your money out earlier, you will get shared for it. Waste cash. People sometimes need to withdraw their mutual funds, and there must be funds available. I mean, cash just for the payouts. So this cash, it's not generating any interest, any profit. Now, lack of control. All types of mutual funds are managed by fund managers. In many cases, the fund manager may be supported by a team of analysts, and consequently, as an investor, you don't have any control over your investment. So all the major decisions concerning your fund are taken by your fund manager. And finally, we have the fluctuating returns. Mutual funds don't offer fixed guaranteed returns, in that you should always be prepared for any eventuality, including depreciation in the value of your mutual fund. In other words, mutual funds entail a wide range of price fluctuations. Okay, now we're going to talk about the active and passive fund management. When we talk about active fund management, we talk about those management that involves frequent buying and selling to obtain superior returns. And the main goal is just to outperform a specific index such as IBEX 35. And then, in order to beat the market and achieve a higher return, this strategy will have also a higher risk or volatility of their assets. And it is known that they require a much deeper analysis. The added value provided by the portfolio manager is valued, so we talk about the alpha. And finally, active funds management entails larger fees from their managers. On the other side, we have the passive fund management. This passive management imitates the market index or a benchmark in order to achieve just the same performance, similar performance. This strategy doesn't have a management team making investment decisions every day. I mean, they can be formed just as an ETF or a mutual fund that replicates the same performance. Then the fund management will use the same weights as in the benchmark index. And finally, there are lower fees as there is no added value from the fund management. So here the alpha is not important.
Okay, so let's take a look at how mutual funds are regulated. And the short answer is more heavily than other kinds of investments. Regulations usually revolve around transparency, so investors need to be updated regularly and accurately. Then liquidity is required by some funds so that investors can withdraw at whatever time they want to, and they therefore require substantial cash reserves, but you'll see more about that later on. Then there are usually precise rules about auditing. The company needs to make available records and information to overseeing entities. And then in the US, they need to publish their mutual fund prospectus on their website and the SEC website, which contains a lot of information for investors. So before you invest in those, to loop back to the previous slides, you would want to look at a mutual funds prospectus. In the US, you have three acts that are most heavily linked to the mutual funds and have a huge impact on them. So first, you have the Securities Act of 1933, which was in response to the 1922 crash and was meant to restore some confidence in the markets. It was designated to create transparency in financial statements of corporations, and it established laws against misrepresentation and fraud. Prior to that, sales of securities had been governed by state laws, but now it was required that companies register with the SEC, and they're required also to reveal important information in their prospectus, and make it public before they go public. Then the Securities Act of 1934 actually went about creating the SEC, because it was needed by 1933, and set aside audit requirements and gave the SEC the power it needed to investigate insider trading, stealing customer funds, and manipulating market prices or disclosing false information. Then later came the Investment Company Act of 1940, which focused primarily on companies whose primary activity is trading securities and whose own securities are offered to the public. And what it demanded of them was that those companies need to publicize their objectives, structure, and operations.
Thank you very much, Alex. Now we move on to the last point of our presentation. We will talk about a topic that we think is very interesting for those investors who want to be billionaires in the future: the top 5 mutual funds in history in terms of returns. In the first position, we find Fidelity Select Software and IT Services. This mutual fund has an average annual return since its creation, July 29, 1985, of 16.05%. This mutual fund has not only survived the crash of 1987, the tech wreck of 2000, and the Great Recession, but it has emerged as the top performing fund since its creation. In the second position, we find Wasatch Microcap. This mutual fund has an average annual return of about 15.96%. This mutual fund mainly operates with microcap stocks, typically thought of as companies between $50 million and $300 million in market value, and are poorly followed by Wall Street analysts, which should give savvy investors an edge. In the third position, Vanguard Health Care Investor. This mutual fund has an average annual return since its creation of 15.79%. It is named as the Cadillac of healthcare funds. This mutual fund has tapped the brakes in the past few years. In the fourth position, we find Fidelity Magellan. This mutual fund has an average annual return since its creation, May 2 of 1963, long time ago, of about 15.74%. This mutual fund is among the best known mutual funds on the market. That's thanks in part to its spectacular beginning, which saw Edward C. Ned Johnson III gain an average return of 30.6% from 1963 through the end of 1971. Then Peter Lynch, a very known investor who ran the fund from 1977 through 1919, produced a sizzling 29.2% gain over his 13 years. And finally, we find the Fidelity Select Healthcare. His average annual return since its inception is 15.37%. Manager Edwin Young has been running this mutual fund for about 11 years, an eternity for Fidelity's sector funds, but it has been a great eternity, and Young has received help from a small army of analysts. Here is the end of our presentation. Thanks for your attention. We hope it has helped you to learn new concepts. If you have any questions, we will be happy to answer them. And if you allow me, I will end with a sentence from the renowned investor Peter Lynch. That is, equity mutual funds are the perfect solution for people who want to own stocks without doing their own research. Thank you.